Anticipation of rate cuts, paving the way for markets to close out November as the best month since 2022. But are investors getting ahead of themselves? Joining us now is Dick Kovacevich, former Wells Fargo CEO. Dick, good to have you. So President Biden tried to make the case that the Thanksgiving meal was the cheapest in a while by historical standards, but housing prices are still stubbornly high. How are you feeling about the latest inflation reads?
Well, I think inflation is declining. The question is how much it will decline. But I think we're really missing the point on inflation. For many Americans, and especially those in low income, it doesn't make a lot of difference whether the inflation rate is at 4% going forward or 2%. The burden that they're suffering is that in the last 2 years, the inflation went up 30% to 40%. That's the problem they have. What they want to see is deflation. They want to see the food, the gas, and so on go down by 10 or 15%, so they don't have to live paycheck to paycheck. So I think there's too much emphasis on whether inflation is going up a little or a little more, as opposed to what the suffering that people are having because of what happened over the last 2 years.
So what about the Fed? What does the Fed need to see for those cuts to happen?
Well, I think we should be careful what we wish for. I think the only way that the Fed is going to be reducing interest rates is if we have a recession. Reducing interest rates before, say, June or July of next year is if we have a recession. We may have a recession. If you remember all the reports from recent companies, they were seeing their revenue go down. They're projecting their profit to go down. So the economy is weakening. Whether it weakens enough for a recession or not, we don't know. But I think that's the only way that we're going to see a reduction in interest rates. But that's not a good thing to have happen for the market or for the economic policies of the country.
It'd be hard to look at a chart of the S&P over the last month or two and get that sense of what we've heard in those earnings reports, though. What do you make of that?
Well, I think they're wrong, quite frankly. I mean, again, it depends upon the earnings reports. Are people correct in what they're saying? And I just think we're seeing weakening all over the place. And I think it'll start coming in the numbers. And remember, we're talking about a very, very small number of companies, the Magnificent Seven, if you will, that are doing well. It's only been in the last couple of days that the broader market has done well. So maybe those 7 companies will continue to do well, but I think they're getting at a level that it's going to be very hard for them to continue to grow their stock if the rest of the economy is not doing well.
Dick, there's pockets, though. Like we were just talking about some of these cyber names like Zscaler that just reported. It's down after hours, but it's more than doubled since its lows from earlier in the spring. So what is it really that you feel is particularly mispriced out there that perhaps isn't reflecting the slower economy and these slower results the way it should?
Let me put it in the other way. I think what is out there that is growing the market is AI and all this technology that we believe in the future is going to be very important, very good, and it's going to help companies of all types. I don't think it's going to happen tomorrow. And the market always looks forward. But when it looks forward, it doesn't see it and doesn't see it enough, or it's being offset by, let's say, just the general companies that aren't that impacted by AI. And because AI is already, quite high, I think, again, there are risks to the market until we get a broader view of a broader success of companies other than the Magnificent Seven or those related to AI.